You open your benefits portal on day 3 of a new job, you scroll past the dental election, and you hit a drop-down that says Roth or Traditional. You stare at it. The guy 2 cubicles over told you to pick Traditional for the tax break. The HR onboarding deck did not explain the difference, so you pick the default, or you pick what he picked, and you click Submit. If you are a college grad earning somewhere between $56,000 and $68,000 in your first job, that 90-second click might be the most expensive shrug of your entire career. I keep seeing this exact scene, and I want to talk you through what your coworker did not. Something changed in retirement law in 2024 that almost nobody at your company has updated their advice for. The old rule was simple and brutal, required minimum distributions. The IRS forced you to start pulling money out of certain retirement accounts at age 73, whether you wanted to or not, and whether you needed it or not. Section 325 of the Secure 2.0 Act killed that requirement for Roth 401k accounts. Quietly, no headline. Most older explainer videos still have not been edited. Hold that. We will come back to it because the full implication of what changed is the part nobody is telling you. First, why this even matters at 25. The whole Roth versus traditional decision collapses to one variable. Your tax rate today versus your tax rate when you withdraw. That is it. That is the whole game. Here is where you sit right now. The 22% bracket is the lowest marginal rate most people in their 20s will ever pay on earned income. Yes, this assumes the One Big Beautiful Bill Act, which Congress passed in July 2025. More on that in a second. That 22% bracket is the lowest marginal rate most people in their 20s will ever pay on earned income. Every dollar you shelter in a Roth 401k today gets locked in at that rate. Forever, done. Every dollar you defer to traditional gets taxed at whatever rate Congress decides in 30 or 40 years. Which brings us to the part that matters. The conventional advice you hear is you'll be in a lower bracket in retirement, so defer. Sit with that for a second. That is a prediction, not a fact. And it has 3 problems your coworker has not thought about. Problem 1. Up to 85% of your Social Security benefits become taxable when your other retirement income crosses certain thresholds. Withdrawals from a traditional 401k count as that income. Roth withdrawals do not. So the disciplined saver who builds a fat traditional balance gets to watch 85% of their Social Security check get pulled into the tax base too. The lower bracket assumption was already wrong before they even opened the second envelope. Problem 2, and this one is uglier, the widow penalty. A married couple filing jointly stays in the 24% bracket up to about $364,000 of taxable income. The surviving spouse filing single hits the 35% bracket starting at $231,250. Same income, different filing status. A large traditional 401k balance becomes an embedded tax liability that lands on the surviving spouse at the worst possible moment of their life. A Roth balance does not. Problem 3. The macro picture. Federal debt has gone from roughly $5.8 trillion in 2001 to over $36 trillion today. Anyone selling you a confident prediction that federal income tax rates will be lower in 2065 than they are today is either selling you something or has not looked at the math. And here is a small signal worth catching. Starting in 2026, Secure 2.0 forces high earners with prior year wages above $150,000 to make their catch-up contributions on a Roth basis. No choice. The IRS is already nudging the system toward Roth for the people who can afford it most. If you have ever watched a relative get blindsided by retirement taxes they did not see coming, hit like, not for me, for the algorithm to push this to other people about to make the same drop-down choice you almost made. Okay, now back to the rule that changed. Here's the part that flips this from good idea to act now. Before 2024, even if you put money in a Roth 401k, the IRS still made you start withdrawing at 73. Same as traditional. Section 325 killed that. Starting in tax year 2024, designated Roth accounts in employer 401k plans no longer require lifetime distributions for the original owner. That is the rule change. And it sounds like a footnote, but it is not. Translate it. The dollars you contribute to a Roth 401k at age 25 can now compound completely untouched, tax-free for the rest of your life. Not until 73, not until 93, until you decide. That is a structural change in what the account actually does. Pre-2024, the Roth 401k was a tax wrapper with a forced exit. Post-2024, it is a tax wrapper with no exit at all unless you want one. For a 25-year-old, the runway just went from 48 years to your full lifetime. 10% average annual returns on $500 a month from 25 to 65 gets you to about $3.16 million. Same $500 a month, but starting at 35 gets you to about $1.13 million. $2 million? Gone. From 1 decade of delay. That is a historical illustration, not a guarantee. Markets do what markets do, but the math of compounding is the math of compounding. And in the Roth, that $3.16 million is yours. In the traditional account, every single dollar of withdrawal gets taxed as ordinary income. The statement balance is not the after-tax balance. They are not the same number. They have never been the same number. This is the kind of distinction nobody makes on a generic explainer video. If you want more of this, the surgical version of advice you have been getting in mush, that's the whole reason this channel exists. Now I know what is sitting in your head right now. 4 objections. Let me dispatch them. The first one, I need the cash flow. The difference between a $500 Roth contribution and a $500 traditional contribution is roughly $110 per month in take-home pay at the 22% bracket. That number wobbles by state and by your withholding setup, but it is in the ballpark. That extra $110 a month, even invested separately, will not compound to offset the embedded tax on a multi-million-dollar traditional balance. The exception is if you carry high-interest debt or have income-driven student loan repayment. Fix those first. Otherwise, the cash flow argument is the wallet talking, not the math. The second one, my match goes in pre-tax anyway, so I'm already diversified. Historically true. The Secure 2.0 Act now lets employers offer Roth matching at their discretion, though most plans still default to pre-tax. Either way, your match is the floor, not the ceiling. Whatever your employer does with the match has nothing to do with the election you make on your own contributions. Quick aside, drop in the comments which side your employer's match defaults to. I keep an updated list and it tells me which plans to dig into next. The third one, can I switch later? Yes. The IRS does not restrict how often you change between Roth and traditional inside your 401k. Your plan administrator sets the frequency. You can change your election next paycheck if you want. There is no tax penalty for switching future contributions. The catch is the only catch that matters in this whole conversation. The dollars you contribute at 25 at 22% cannot be recontributed at 25 at 22%. Once that calendar year passes, that door closes, 1 year at a time. Now, where does the framework break? There are 2 situations where the standard click Roth advice does not hold, and you should hear both. First, if you live in a high income tax state and have a credible, concrete plan to retire in a no income tax state. California to Florida, New York to Texas, the traditional case gets meaningfully stronger. You defer combined federal plus state today and pay only federal in retirement. That is real arbitrage, not a vague hope, a plan. Second, if you are 25 and already earning above the 24% bracket threshold, or your household income puts you in the 32% bracket, the immediate deduction starts to outweigh the Roth case. The Roth first argument is strongest in the 12% and 22% brackets. If you are above that, the math shifts. So, the framework. Get the full employer match first. That is non-negotiable. The match is guaranteed return regardless of which side you pick. If your federal marginal rate is 12 or 22%, lean heavily Roth. If you are in the 24% bracket with rising income, an 80-20 Roth traditional split is a defensible hedge. If the high tax state to no tax state arbitrage applies to you, weight traditional more. That is the drop-down decision, tonight. This is general education, not personalized advice for your specific situation. Before you change anything in your benefits portal, talk to a financial advisor or a CPA who knows your full picture. Your debt, your state, your spouse's situation, your income trajectory. They can catch what a video cannot, but here is the question that comes next, the one that changes the math even more. Once you have the Roth 401k election dialed in, what is the actual order in which to fund your accounts? Match, Roth IRA, max the 401k, HSA, to give yourself the most flexibility to retire on your terms regardless of what life throws at you? The order genuinely matters, and the next video walks through someone who saved every paycheck for 31 years and still got it wrong. I'll see you there. Thanks for watching.